Hey there, financial voyagers, and welcome back to Investing Lighthouse. Buckle up because we're about to navigate some rough seas. Today, we're charting the course through the choppy waters of banking crises. Now, you might be thinking, banking crisis? Is that when my online banking app crashes? Well, not exactly. So let's get started. A banking crisis is a financial condition where significant fractions of banks or financial institutions in a country face difficulties simultaneously, leading to the potential collapse of an entire banking system. It's like a forest fire in the world of finance, spreading rapidly and causing devastation. One classic example, etched into the annals of banking history, is the Wall Street crash of 1929, leading to the Great Depression. Banks were over-leveraged, investors were panicking, and everyone wanted their money back now. That's when the US learned the hard way how quickly a banking system can go from flourishing to floundering. So how do banking crises come about? They're like a perfect storm. Several factors often converge to create a disaster. For starters, poor risk management by banks can plant the seeds of a crisis. In their quest for profits, banks might start taking on too much risk, lending recklessly, and ignoring warning signs. Then there's the good old herd mentality, where one bank's failure can make others panic, creating a contagion effect. Now, imagine being in the early 1900s, witnessing a banking crisis. The news would take ages to spread, and it would take time for the panic to set in. But today, with technology, we live in the era of blink and you'll miss it. If there's a whisper of a bank failing, millions can be transferred with just the click of a button, accelerating the crisis. So let's now talk about what is a bank run. It is not your usual morning jog. It's when depositors, fearing a bank's potential insolvency, rush to withdraw their deposits. It's comparable to a game of musical chairs, in which everyone scrambles for money before the music stops. Now, you might wonder, could fear of one bank failing lead to a systemic crisis? The answer is, sadly, yes. This is called contagion, which can quickly snowball from one bank to the entire financial system. Think of it as a nasty virus, spreading and infecting every bank in its path. An old saying goes, building trust requires years of effort, but it can be shattered in mere seconds, and repairing it may take a lifetime. Nowhere this is truer than in our banking system. Trust, my friends, is the bedrock of our financial institutions, and it's a fickle beast. Like a house of cards, a slight shift is all it takes for the whole structure to crumble. Once depositors start to doubt a bank's stability, they rush to withdraw their money, causing a bank run. And with today's technology, this can happen at lightning speed. A single tweet or news alert can trigger a mass panic that would have taken days to spread in the pre-internet era. In an ironic twist, the very act of striving to avoid losses can end up causing it. The actions of frightened depositors can bring down banks that might have weathered the storm. Trust, or rather, the lack of it, becomes a self-fulfilling prophecy. And as we've seen earlier this year in the US, 2023 is no stranger to banking crises. Imagine a scene from a movie where the first domino falls, and you know it's just the beginning. The same happened in the banking world. The first domino to tumble was none other than the crypto-friendly Silvergate Bank. By the end of 2022, a whopping 90% of its deposits were crypto-related. Unfortunately, Silvergate's conservative approach to its investment portfolio didn't prevent its demise. It invested money from its depositors in mortgage-backed securities and US bonds. Assets reliable for total payback at maturity but prone to risks with interest rate changes. Think of it as a seesaw. As interest rates shot up in 2022 and 2023 to fight the inflation surge, the value of these securities took a nosedive. Usually, a bank could weather these paper losses. But if you're forced to sell those securities at a lower market price, you're locking in actual losses. And boy, did Silvergate feel the squeeze. When FTX, a crypto trading giant, went bankrupt, Silvergate was hit with a tsunami of withdrawal requests. Deposits from crypto firms plunged by 68%, with clients asking to pull out over $8 billion. But Silvergate didn't have that kind of cash lying around, so it started selling off assets at a considerable loss, realizing a loss of $718 million in Q4 2022 alone. In the end, faced with mounting losses and nowhere to turn, Silvergate decided to wind down operations on March 8th of 2023. Yet, the ripple effect was just starting. A mere 2 days later, Silicon Valley Bank, trying to raise capital, faced a sudden bank run. The fear had spread, and Silicon Valley Bank collapsed. Snatched up by regulators the same day, SVB was no ordinary bank. It was like the cool kid at the tech industry's lunch table. Nearly half of all US venture capital-backed tech and healthcare companies were financed by SVB. Think of it as the financial fuel behind the next Amazon or Apple. By the end of 2022, SVB had assets worth a staggering $209 billion, making it the 16th largest bank in the United States. Thanks to the tech sector's growth, they saw their deposit holdings increase during the COVID-19 pandemic. In 2021, SVB decided to buy long-term treasury bonds with these short-term deposits, hoping to turn a profit. However, with the Federal Reserve jacking up interest rates to control the 2021-2023 inflation surge, the value of these bonds took a hit. The higher interest rates also meant borrowing became costlier for everyone, and some SVB clients began pulling money out to keep their boats afloat. SVB, trying to keep the ship steady, announced on March 8th that they had sold over $21 billion worth of securities, borrowed $15 billion, and planned an emergency stock sale to raise $2.25 billion. It was like a yard sale on steroids, trying to get cash any way they could. But as you all know, panic spreads like wildfire. The announcement and warnings from Silicon Valley investors sparked a massive bank run. Customers withdrew a jaw-dropping $42 billion by the next day. So, on March 10th, 2023, the inevitable happened. SVB was seized and handed over to the FDIC. In the wake of Silicon Valley Bank's collapse, federal regulators sprang into action, promising to shield all depositors, even those whose funds weren't covered by the FDIC's $250,000 insurance cap. The Federal Reserve took bold steps to restore confidence in the banking system, hoping to prevent further banking catastrophes. Picture this. It's like a safety net that catches you even when you fall outside its original borders. This is like your insurance company saying they'll cover everything, no matter what. Even those costly sunglasses you lost on your last beach trip. Isn't that reassuring? Well, that's what the Federal Reserve announced on March 12th, invoking what's known as a systemic risk exception. Why this sudden generosity, you ask? The simple answer is the domino effect. The fear of contagion is real and significant. If one bank's collapse can have this much impact, think about what might happen if people lose faith in the entire banking system. The systemic risk exception was not just a move to protect SVB's depositors. It was a carefully calculated step to protect the economy as a whole, to stop the dominoes from toppling. It was like putting a safety barrier around the rest of the banking system. But on the same day as the Fed stepped in to save the day, Signature Bank, which also catered to crypto firms, was shut down by regulators. As the dominoes fell, the focus shifted to other US banks. And First Republic Bank, the 14th largest US bank at the end of 2022, was under the microscope. On March 13th, its shares took a roller coaster ride, plummeting by a whopping 62%. Now, imagine having to confront significant liquidity issues after a fall like that. In April, the bank revealed that deposits had plummeted by over $100 billion. sending the bank's share price on a free fall of over 20%. By the month's end, the bank announced it planned to start selling its bonds and securities at a loss to raise equity, and its stock price tanked 43%. On May 1st, 2023, First Republic Bank was closed, and its assets were sold to JP Morgan for a relatively modest $10.6 billion. The failures of First Republic Bank, Silicon Valley Bank, and Signature Bank ranked as the second, third, and fourth largest bank collapses in the history of the United States, respectively, surpassed only by the collapse of Washington Mutual during the 2007-2008 financial crisis. So, as you can see, financial voyagers, the sea of finance can be treacherous, with dangers lurking beneath the surface. But remember, understanding the past and learning from it can help us navigate safely through these choppy waters. And that concludes our exploration of this financial voyage, dear viewers. We're eager to hear your perspectives on the recent banking turbulence. We're eager to hear your thoughts, so go ahead and leave a comment below. If you found this video enlightening, please give it a thumbs up. And if you have not done so already, click on that subscribe button and join us on this exciting journey. Keep sailing, adventurers. Until we meet again on our next financial expedition. This is your Financial Compass, signing off.